Rates are the highest level this century. So what's going on? Okay, so this month, mortgage rates rose up to 7.5%, the highest level we've seen this century, well, almost by a month. But just for context, the last time that mortgage rates were this high, you probably checked your email on, I don't know, like your Nokia or your Siemens or your Motorola Timeport. Yes, the phone before the famous Motorola Razr that wouldn't come out for a few years later. Understanding the housing market is now at a generational gap for many millennials and Generation Z homebuyers who have experienced ultra low rates up to 2022. Yet to understand how far on the moon we've been living the last 23 years, consider this. These new rates are still less than the historic US mortgage rate. The 30-year mortgage rate has averaged 7.75% from 1971 to 2023. That was the first year that Freddie Mac started surveying mortgage lenders, where it then reached an all-time high of 18.6% in 1981. 18.6. Look, the oldest Generation Z was only 4 years old at the last time that the rates were this high. Now that gravity is bringing us down to reality, what's in store for a hobbling real estate market? With the latest surge in rates, are real estate prices declining in response? Well, yes and no. Let's dive deeper into which real estate sectors are rising and which are falling. Okay, let's begin with home loan applicants. They're declining. Home loan applications fell to the lowest level since 1995 last week, and that was according to the Mortgage Bankers Association. This includes home mortgages, plummeted HELOC applications, and the almost non-existent refinance applications. High rates are making mortgage payments, well, more unaffordable for so many buyers. The median monthly payment listed on home applications has rose 18% from just a year earlier. The result of rising rates has finally had the intended effect that the Fed has been attempting to do by raising the interest rates, which is to extinguish inflation by pulling back demand and spending, particularly in the big real estate market. So what other markets are affected? Well, banks are also loaning less, and less loans means less farm loans, less business loans, less commercial loans, and less construction loans. You know, supply, the supply that we need to fix the housing market. So what's going on? Well, rising rates are causing a mismatch on the bank's balance sheets. These higher yields are causing debt prices to fall. That's reducing the value of trillions of dollars in fixed rate loans that the banks hold, sometimes greater than the bank's equity itself. Earlier this spring, over just the course of 5 days, unrealized losses led to 3 regional banks collapsing. The result has been banks increasing loan standards and providing fewer and fewer loans. As banks are tightening up low standards and lending less loans, that is having a huge effect on the number of real estate sectors, particularly in commercial real estate, such as in income properties, such as rentals, farms, and construction loans, which are financed internally by local bank in-house financing. So what else is happening? Commercial and condominium markets are Look, large projects such as apartment developments have declined 41% from the same month a year before, says the Census Bureau. The biggest contributors is the cost and scarcity of construction financing, as banks are lending less with the rising rates to support other loans that they had on hold prior to the rate hikes. Other real estate, such as commercial real estate in particular, is flashing some serious warning signs as leasing on retail and warehouse spaces have slowed, and the office sector is just bleeding vacancies at 19.2% now, which is like near the national historic peak of 19.3, which was back in 1991. Big investors from Wall Street who flooded the market purchasing single-family homes in the pandemic era are also drying up. We're seeing a huge slump in the commercial and condominium sectors. But here's a market that is winning. Home prices rise again. Single-family properties now are the only type of property that has increased in property value since the interest rates began to rise in March of 2022. Last month, the median existing home price for all housing types rose to $407,000. That's a 4% increase of a year earlier, according to NAR. Who else might be benefiting? Well, the buyers, because those prices have continued to climb, but there's also less buyers, leading to less competition for home. That is, if you can stretch the budget for that higher monthly mortgage cost because the rates are going up. But hey, look, buying a home is more than just a pure financial investment. It has made the single-family sector uniquely less vulnerable, as it's more of an emotional purchase. So what other sector and story do we have to follow? Well, believe it or not, home prices may not be at their peak. Look, real estate broker, investor, and Shark Tank star Barbara Crocken believes single-family homes are far from their peak and that they might soon, quote, go through the roof. She predicts there's currently a bottleneck of softening demand caused by the higher rates that are still not offsetting the vast inventory shortage that we have. It's continuing to grow and get larger as builder confidence softens during the rate hikes. She says, quote, the sellers don't want to move because they don't want to take on the higher interest rates, but the buyers are too afraid to buy because they're getting less house for the price. So you got a standoff going on, but things are gonna change, she says. She believes that a major shift is gonna occur when interest rates drop. And she says, quote, the minute those rates drop and come down, all hell's going to break loose and the prices are gonna go through the roof. It's gonna be a signal for everybody to come back out and buy like crazy. And the houses are gonna be like 20% more. We have COVID market all over again. Though she has some optimism for the residential sector, Barbara views the commercial and residential markets as separate entities with a long rebound expected for the commercial sector. So what are my thoughts on this? Well, there's a number of recent articles published that are showing there's a resurgence in renting over buying, with some stating it's way less expensive to rent than to buy with the current market conditions of interest rates hiking and coupled with rising prices. A market that I've seen resilient and growing locally in my market in Iowa City is the luxury market. Look, the bottom line is people need to move, whether you're purchasing or renting. And the American dream has been to own, where you can control living expenses, have the freedom to decorate and make changes as you wish. And of course, be the king of your castle. This is different than any other country, such as countries in Europe that have flipped ownership and rental rates compared to the US. I mean, in like Germany, instead of 70% owner, 30% rent, it's the exact opposite. It's like 30% owner, 70% rent. Homeownership in the US has been, for the most part, a pathway to building wealth, but low affordability puts us increasingly out of reach for so many who have yet to buy. The issue is those that are locked out of buying houses are turning to the rental market and keeping the rental prices elevated. Here's my final thought. If mortgage rates are so high, it's almost a reason to buy on the simple grounds that they have to come down at some point, and when mortgage rates come down, prices go up. Hey, thanks for watching my video. I hope you enjoyed this news update. If you want to see more news updates on real estate, luxury home tours, or just see what's going on in Iowa City, because this is a really cool place, make sure to subscribe to my channel down below. Thanks for watching, and we'll see you again next time.